Welcome to the Organic Wine Podcast. Hello, this is Adam Huss coming to you from Los Angeles, California. Thanks so much for listening. The Organic Wine Podcast is brought to you by Centralis. Centralis is my winery that I started with my wife, Wendy, because we thought it was unacceptable that the majority of our wine choices today force us to support quote-unquote conventional industrial agriculture that harms us and the world, and opaque production practices that turns wine into a mystery beverage. Most wines don't reflect what we want or who we are, and we were tired of organic farming and transparent winemaking being niche. We want them to be the norm. You can learn more about Centralis and purchase our wines and join our wine club and email list at centraliswine.com. That's CENTRALAS wine.com. This episode is a bit unusual for this podcast. It's about how to purchase real estate, and my guest is rural mortgage banker for United Ag Lending, Brady Shepherd. I'm very grateful to Brady for the time he spent with me preparing for this episode, and I think you'll find this episode packed with potentially life-changing ideas. Why life-changing? Because, for better or for worse, the U.S. economy is founded on real estate. The laws and economic structure that guide our society were written by and for landowners. And behind every glass of wine is a piece of land where it was grown that somebody or some entity owns. Did you know that you can buy real estate with less than 20% down? You might not even have to put any cash down. And your credit doesn't have to be perfect either. We talk about these ideas and so much more in this episode. I also want to give a shout out to Sugar Todd, who inspired me to consider doing this episode. And I want to share one more idea that was an inspiration for this episode. Did you know that as a self-employed individual, if you own your own winery or other business, for example, you can set up a 401k for yourself? As the business owner and employee, you can contribute two separate amounts of funds to the 401k, so you're double contributing. And here's a crucial bit, you can set up a 401k that is self-directed. That means you don't have to invest those funds into the stock market. You can invest them in any investment opportunity that you find, and that includes real estate, for example. And if you had a job or currently have a second job outside of your self-employed business where you have a 401k, you can roll those funds from previous jobs or current jobs into your self-directed 401k. Now, I could probably do a whole episode on just this strategy, but I wanted to mention it because if it could apply to your situation, it's a potentially incredible way to leverage your business to invest in real estate. A final disclaimer, nothing that I or Brady say on this episode is meant to be investment advice. And please talk to an accountant about your personal situation. Actually, talking to an accountant can be just as eye-opening as talking to a mortgage banker. A big thanks to Brady, who, if you stay tuned, literally gives his phone number for anyone who might need help getting a mortgage loan. Enjoy. Brady, thank you so much for doing this, and welcome. And I'm wondering if you could sort of introduce yourself, saying, who you are and what you do and why we started talking.
Yeah, of course. And thank you for having me. So I have been in the mortgage industry now for a little over 20 years. I didn't intend to start out on that path, but you know, uh, destiny has a funny way of introducing itself. But I had initially gone to a conservatory of music for performance, emphasis on voice and doing opera. And just kind of got into banking as a side job, and then slowly kind
As
of
one
transition.
does, as
Right.
as your average opera singer does.
Exactly. So I like to joke about that and say, I do sing opera. So naturally, I also do mortgages. So it's fair. But it has been a very, very interesting adventure. So I've been working on the residential side for a very long time, as well as doing agriculture loans, which is kind of how we got hooked up and started chatting.
Yeah, and thank you for adding that hook, because I think, just starting off this episode of the Organic Wine Podcast by introducing a mortgage broker, or mortgage banker
Yeah.
will confuse some people, but you just drove it home there, which was, I've just had multiple conversations now with young up and coming winemakers, or just people who are interested in the wine industry and getting involved. And of course, the unspoken thing behind this episode, this entire show, is the fact that wine is an agricultural product,
Sure.
and reconnecting people to agriculture is a big emphasis of what I'm trying to do, to show its importance, to bring it back into the center of focus for wine. And then behind that, the unspoken thing behind agriculture is land,
Right.
and the primacy of the need for owning real estate or controlling real estate in some way to be able to do agriculture. And so multiple conversations I've had just brought to me the importance of sort of talking about real estate and acquiring real estate, or what options are available. And what I've found, and my history is, like, I was a real estate agent for a few years in Los Angeles, and have learned a lot through that process as well. And it's definitely informed me. And a big part of why I became a real estate agent at that time was I had gone through this process in the midst of, I guess it's always crazy real estate in Los Angeles, but I had been through a process of buying my first home and realized how instrumental it is to financial well-being, real how just fundamental real estate is to our entire economy. I'd learned this enormous amount of just how it works, and the process of getting loans, and the different kinds of loans that are available. And I wanted to share that. I wanted to help
Yeah.
people, because I realized how removed most people are from this information that I began to realize was so fundamental to breaking cycles of poverty, to building wealth, to just participating in this economy at a level that beyond just paycheck to paycheck existence. And so it has a real personal meaning to me. And I'm sorry, I'm taking your airtime. We're gonna
No,
get to you
no,
quickly,
you're fine. All
but
good points. All good points.
yeah. So a lot of the people that I spoke with, it's really just, what was that first step? Like, I don't even know where to begin. And as I thought about this, who would be a person to talk to? Who is the first person you talk to? Really, it's not an agent per se, because that they're going to facilitate you in doing paperwork for purchases, but it's the people that make the deal. It's the bankers, the mortgage brokers, that are really setting the terms for what we can do, how much we can afford, who let us know how much we can afford, and what
Right.
options are available to us, what investment instruments, what loan instruments are available. And so that's why I started looking and found you, and you've been so great to do this. So again, thank you and I
Of
just wanted to
course.
set that stage, and give wet people's whistle that this will be a nice, juicy, practical thing. And so just to start, let's talk about some of the advantages to owning real estate. I sort of mentioned, my sort of awakening awareness of how important it was just to economic well-being and wealth building and that kind of thing.
Right.
But practically, like, what are the advantages to owning a piece of real estate? You want to talk about some of those?
Yeah, of course. So one of the biggest advantages that I do like to bring up with people is, and we had discussed this before as well, but if you ask kind of point blank to anybody really, if they have a set schedule of how much money they actually set aside, like, do you have retirement funds? Do you have something set up with your employer? Do you have savings accounts? And the one thing that really goes by the wayside is a savings account. So if you say, I have 10% or 15% of my paycheck, or each paycheck that automatically goes into that savings account, that's great. But where the big advantage with a mortgage in particular, is that payment is set up so that you've got a clear division of principal and interest in that payment. Now, that principal, you're paying yourself. So it's already built into that payment. So you don't really even have to think about it. It just automatically goes aside, and you just build equity each month, month after month. Now that's also provided that the market is doing well, which right now has been kind of going gangbusters. So people have noticed a huge influx in equity that they can tap into in their property. Maybe turn that property, sell it, take that equity, put it into something else. So that's the easiest thing to point out.
Yeah, that's a really cool analogy
Yeah.
about. I think you asked me that question of like, how many people do you know are putting, $235 a month into a savings account? But your point being essentially, whatever your principal is, that is essentially what you're doing is putting that aside as
Right. You're paying
just
yourself.
saved money.
Hmm.
Yeah, that potentially at the very least, is just growing because you're adding more to it. And ideally maybe appreciate, the value of your property may be appreciating and maybe I'm jumping ahead as that's another advantage to potentially
Yeah.
owning
Yeah.
real estate. It's
Absolutely.
appreciation. But yeah, continue. Sorry. So I do like that analogy though of like the savings account.
Yeah, of course. And then some people, they just kind of build off from there. So it may be more than about just acquiring one property and moving into a different one, but kind of turning that property that you're leaving, that departure residence, into a rental where you have a tenant who comes in. They're essentially making that payment for you. So they're the ones who are putting that money into that savings account, building that equity for you while you move on into a different property. So, and a lot of people operate that way, and they kind of build that wealth by adding more houses to their portfolio.
And when we talk about, so there, maybe it's good to make the distinction. There's some real just basic advantages to say buying a home or buying a piece of property that you're going to use yourself, and
Right.
that you just already mentioned that it's sort of like an automatic savings account. You can build equity in that if and even just with savings, even if it doesn't appreciate, and if it does appreciate, you build even more equity, and that equity can then be, you can take out a home equity line of credit, which can be used to buy other properties,
Right.
or to invest in other investment opportunities that can make more money, that can generate more wealth. And then there's the second class, I guess, is when what the advantages are to not just having a piece of property that you are using, but to having a piece of property that you are using as an investment. So you've bought it to generate income, and traditionally what we think of is what you just mentioned with tenants, but this is where I think agricultural land can come into play, because I
Hmm.
think there was a podcast that I did with a former accountant who has purchased several vineyards in the Central Coast area here in California, and I was asking him about that, and that's the way he described his purchasing of these vineyards is like essentially. I was like, how do you make it work? Considering how tough it is to make money, and that was the simple calculation that he gave, was like, you buy a piece of land at the right price, and you can sell the grapes from that
Hmm.
property to essentially the grapes are your tenants, like they pay the
Right.
mortgage on your property, and you meanwhile are building equity. You're every year that you're selling the grapes and paying the mortgage, you're building equity in that property.
Right.
So also for both of these kinds of things, whether it's your primary or an investment property, there are tax advantages, right? Can you sort of break down how that works,
Um,
or the basics of that?
Yeah, on that, I always when that topic comes up, I always defer it to, if someone has an accountant or a CPA. We can't promise anything, but we do like to kind of give that disclaimer that, when we're talking to someone, say, well, property does come with tax advantages, but that's something that you're going to want to talk to your accountant about, because really every individual's financial situation is very much like a fingerprint. Every single one is just a little bit different. So I wouldn't be able to come in and say, yes, this is the same tax benefit that every single person gets, because that wouldn't be true. So,
Right.
unfortunately, it's not quite that black and white. It is a very big gray area. So that's where your CPA and those accountants will come in and say, okay, yes, you absolutely do have some extra tax advantages. Or another individual might say, your current situation, probably not so much, but it's still a good thing to own that property. It's still, you know, building wealth for you.
Yeah, I mean, some of those advantages, and we won't say that they will apply, but could
Could.
include like writing off your property taxes and the insurance that you pay for that for your primary residence, for example.
Right, right,
Expenses like if you have an investment property, in addition to your primary or instead of a primary, um, potentially write off the expenses associated with managing and maintaining that property. You can potentially write off depreciation, which is a sort of calculation
right, right.
of how much it is devalued over like 24 and a half years or something like
Yeah,
that. I,
yeah,
I don't know exactly what it
yeah,
is, but
exactly.
why it's good to involve an accountant. But
Right,
it's stuff that you wouldn't even hear of without an accountant telling you about it. So that's why it's once you get into that thing, it's you can look it up, but you definitely, right, like you said, should be talking to somebody about how to figure that out for that specific property and your
right.
specific situation.
And TurboTax is great, but it might not might
Yeah.
not tell you everything that you're really looking
Yeah.
for. So
Yeah.
that's where your professional comes into play. So
Well, and okay, so maybe the transition that I'll say is to give as a final advantage, not that this is a complete list of advantages, but just to, wet people's whistle to get them excited about why real estate is a valuable thing to consider. Um, Especially in the investment thing, is this idea of using leverage, which is just a fancy word for, getting a loan, and being able to buy a property without having the cash to pay for $1 million property. You don't have
right,
to have all that money. You can have a fraction of that and still buy something that's worth that much, which is, there are other examples of that in the world, but it is a really important aspect of this asset class. And that's kind of where you come in, because most people, especially with today's housing prices, and maybe before we transition, but I was going to say, with today's housing prices, most people can't pay cash for a piece of property, whether it's a farm in the middle of nowhere, or which, because I think farmland right now is just as expensive as LA real estate in some places.
yeah, yeah. Depending on the area that you're in, definitely can get pretty outrageous pretty quickly.
Yeah, I mean, I know, like Napa, for example.
Yeah.
It's you just forget about it. But is some interesting things have just changed in the landscape. So we're talking just after whatever May 1st, where it's what is it today? May 7th.
Uh,
And this week the Fed raised the rate a half point. How does that impact real estate, and what what do you think about the purchasing landscape right now? Is it a good time to buy real estate? What are your thoughts?
um, there. That's a real
It's
jam-packed, loaded question.
I know.
So, I would say certainly there have been better times to buy, but there's never really a truly bad time to buy, because once you acquire that property, it's an asset. Whether you buy high or buy low, so it's just a plain asset that you're adding to your portfolio, which is always a good thing. Now, rates, they they come and go. There's a lot of ebb and flow with that pricing model. We have been conditioned for a very long time, for the past several years, uh, for lower rates. But even with the rate hikes and housing prices going up, it's still Historically, when you look at the big picture, we're still on the very, very low end of that cusp. So, we're still very low. Um,
Yeah, they say, you know, the the best time to buy real estate or plant a tree is 20 years ago, and the second best time is now.
yeah, yeah,
um,
there you go.
uh, and of course, I think what you're saying, though, to the point of where we are right now, there have been better times, and you sort of have to look at each opportunity individually, anyway, regardless
Exactly.
of what time in history it is. Like, does it make sense? Does it pencil out, as an investment? And that is much more important than the where you are now, because yeah, if you look in 20 years, I think over almost any 20-year time, I can't think, I don't know, I'm sure there are places around the country maybe that doesn't pan out, but it seems like if you're holding it for 20 years, you probably come out ahead.
You're
Although
right.
um
It's just such a
uh
big picture thing. It's kind of
right.
difficult to wrap your mind around it, especially if it's a first time investment for yourself. It's very difficult to see that long game, and to get really focused on, well, where is it going to be in a year, or where is it going to be in 6 months? So it's hard to really quantify an asset that way. It's much easier to do that 10-year landscape, or that 15 or 20-year that you're talking about.
So getting back to, I'm trying to be in the mindset of somebody who really knows nothing, and hopefully we touched on some ideas just to like tantalize the minds of those who are listening. And I tried to do this transition about leverage and how that leads to you and where you come in,
Hmm.
and why I think really you start with somebody like you, why somebody would start with a banker, mortgage, a mortgage lender of some variety,
Sure.
because you don't know really what you can do until you talk to somebody like you. If you don't know where to begin, the best place to start is with somebody like you who can sort of educate you on, okay, what is your financial situation? Because that's what you do. You start by looking at that and then say, this is what you can afford. How much do you have in cash that you plan to use for this house, or property, or whatever it is? And therefore, what can you afford? Can you talk about that? What how that all begins, and what somebody what sort of
Yeah.
first step somebody should take in order to prepare for making a purchase,
Right.
and having, I mean, other than get on the phone and call you,
Right.
which is a good first step, I think. But if you want to expound on that.
Yeah, of course. So what we kind of tell people, when I first have that conversation, and especially first time home buyers, it is very difficult to get the right information without talking to the person dealing with loans directly. Just because there's so much information and misinformation out there, and a lot of times we find that new buyers in particular will try and qualify themselves, which is the worst
Right.
thing that you can do. Um, so,
Right.
we
Right.
look at those first time home buyers and say, no, you don't need a full 20% as a down payment, regardless of what mom and dad have told you, because that's when they got their mortgage.
Right.
25, 30 years ago, it was very different, different lending
Right.
guidelines back then. And it's just simply not true today. There are plenty of resources out there for lower down payment options, and people are honestly sometimes shocked that, okay, I do qualify for something. And then on the other
Well,
side, yeah, go ahead.
yeah, I just want to underline that. So let's start with that as a first piece of truth. So let's we let's, I want to restate that you don't need 20% down to buy a piece of property, especially if it's your first property. There's even some special. Well, we'll get into that, but you don't need 20% down. Period. What is a reality? Like, what is the percentage that you need? What are options are available?
Yeah, yeah, of course. So you have options anywhere from, honestly, zero down, to 3% down, 5% down, 3.5% down. So there are a variety of options, depending on
What
the
is the
type of,
how,
yeah.
Sorry, yeah, you're probably about to answer this, but what would be a how could you do a 0% down?
Okay, so this is going to be more of a rural type property, so a
Okay,
USDA loan, or an RD loan, what some might know it as. It's going to be, homes that are on kind of the fringes of the city. So it's not going to be, in big cities. It's going to be on the outside in, less dense populations. So
maybe perfect for a place where you want to plant a vineyard, perhaps?
Yeah, yeah, absolutely. So you got a
Okay, all right.
little more open ground. So the house itself also needs to be within an eligible area. So that's something that a lender will check. When they've got a client who you don't have a lot of funds, you don't have a family member who can gift funds to you. So those zero down payment options come into play. Um,
Okay. So they actually checked if your family's financial situation or whether you have family at all?
No, it's just a recommendation. Sometimes, when we go
Got it.
through and
Okay.
say, what kind of financials are we working with as far as down payment?
Got it.
They say, I've got maybe $500 in the bank. So we say, well, that's probably not going to be enough. So we're gonna, not to squash anyone's dreams or anything, but we may say, if you have a family member or a relative who can gift some funds to you, we can use that as down payment. And then if that's not an option, then USDA loans would be a good option for them. Or if they qualify and they have military benefits, they can always do a VA loan. So that's also a
And
government program that's a
and
zero.
is a
Hmm.
VA has a zero down
Right.
option?
Yep.
Okay. And are these zero down that you said they're sort of not urban center properties, but would they apply to agricultural properties? Like could you purchase a piece of property that was zoned for agriculture that had a house on it with
You
this kind of thing?
you can, with those rural loans, but if we're looking at the full USDA loan, there are some stipulations as far as how big the property can be. So those kind of things, you would want to be a little more careful of, and if they don't fit that particular puzzle, then we transition over into the agriculture type loans, and those are going to actually require a larger down payment on, than those USDA loans.
Now, do you happen to know what the size limit is on those USDA loans
Um,
for the property?
off the top of my head, I know that 20 acres is probably going to be the maximum.
Okay.
So they'll probably want them under that mark.
Yeah, I think for a lot of people that would still be really an exciting option.
Yeah, still sizable.
Yeah. That's really great to know. I wasn't aware of that. And now the ones that I am more aware of are like 3%. So this is when we move into the 3% down,
Hmm.
they're essentially it's a conventional loan at 3%, right? Like there's not really a restriction on where
Correct.
or what. It's you're just getting a normal loan, but you only
Right.
have to put 3% down. The one catch is and for anything that's under 20%, um, if I'm correct, is
Hmm.
that there's PMI. Do you want
Right.
to talk about PMI?
Yeah, yeah. So that is very true. Anything less than 20% down payment does require PMI, private mortgage insurance, that is added into the loan. This is more insurance for the lender since there isn't that full 20%. But it can come in two different forms. So if that is going to make our payment too high, almost always that PMI is just factored into that loan payment, but they have the option of doing what's called a single premium PMI, where it essentially takes a chunk of that PMI and it's just paid at closing, just like a typical closing cost, and takes it out of that payment. When we do that, I have always recommended that if you have a seller who's willing to pay some or even all of those closing costs, that might be a prime time to utilize that option and take it out of your mortgage payment and just have the seller pay that entire lump sum PMI.
Got it. That's very interesting. Yeah, it's so just to recap. So you can purchase a home for 3% down, let's say,
Right.
and you'll your payment. Let's talk about the payment. So you'll
Mhm.
let's bring up these terms now, like PITI, PITI, which is principal, interest, taxes, and insurance, and that's
Right.
homeowners insurance, property taxes, and then the principal and interest of the
Just the
loan
base
and
payment. Hmm?
the base payment. And usually they're separate. Usually if you're buying, a home on a conventional loan, those will all be wrapped into one payment, and the interest and insurance, I'm sorry, the insurance and taxes will be escrowed into an account that the bank pays, because they want to guarantee that those are getting paid, because that could
Right.
affect the ownership of the property, which since they own the note on the property, as long as you have a mortgage, they don't want that to be impacted.
Right.
Now, with anything less than 20% down, there's a fifth element on top of pity, and that's the PMI, the mortgage insurance, and
Mhm.
that's just another chunk of money that you're paying on that monthly payment that goes to the bank as a form of insurance, because you didn't have that full amount down.
Correct.
Okay. And then you're saying that you could negotiate a situation where the seller is covering PMI. Can you
Correct.
repeat that?
Correct.
Okay.
Yes. So, and that's the one thing that not very many people know about, but we do get a lot of pushback with, people saying, "I don't like." It's sort of been trained into them, and I think that's part media, part family, and nothing to do with the lending professional. So, they say, "I don't want to pay PMI. I don't want to pay PMI." Well, if you don't have 20% as a down payment, you're going to pay PMI in some form or another. So if you don't want to pay it monthly, take it out of the payment. So you're not paying that PMI at all, and have the seller pay it in one lump sum. So that is called a single premium PMI. And it's usually,
Interesting.
it factors out to whatever, I think it's about 3.5 years worth of PMI payments. So it just
Okay.
takes 40 some odd months worth of payments and lumps it in as one closing cost. I would utilize that
Oh.
option if you have an abundance of seller concessions, or the seller has opted to pay all of your closing costs. Then absolutely 100% have them pay that.
Now, oftentimes that gets added into your loan amount. Is that correct?
Not when it's the single premium PMI. It'll just show up
Okay. So this would
as,
be okay.
yeah.
This would be a seller's closing cost.
Uh-huh.
Okay.
So the
Wild.
seller can pay that. If they're not, then the buyer obviously has to pay that. But depending on the sale price and the loan amount, that can get pretty costly. That's why I usually recommend, if you're going to take that out of the payment and utilize that single premium payment option, have the seller pay that, as
Right.
opposed to the buyer incurring that expense.
Now, and this would only make sense if the seller really wanted to sell. Like if
Right.
it's a seller's market, as they say, which it seems like we've been in for a while, that's an unlikely scenario for most situations.
Right,
Is that
right.
correct? I'm
Unless you're
assuming, yeah.
yeah, unless you're going to offer above asking, which also has been happening, but
Oh,
um
yeah.
it's a good way to, have the seller net what they want to net out of the sale of their house, as well as the buyer getting some assistance from that seller.
That is a really cool idea. Um, wow. We're getting nuggets here. I love
Yeah.
this. This is even for somebody like me that is. I feel like I've heard it all. There's a couple new ones already. So
Yeah.
this is fantastic. Um, all right. So let's talk again about, like, going back to just your first time.
Mhm.
Some questions surrounding that, especially since I'm approaching this from somebody who, they're not just interested in a home, but they're interested in, a home on which they can plant vines
Yeah,
and
yeah.
make wine, for example, or plant, trees or whatever it is, whatever kind of fruit, is good for where they live, and they want, they want to do agriculture, they want to make something, they want to ferment something. Um, do you recommend buying land with no home at first, or any thoughts about that? Like, what are the pros and cons?
Well, being that I do residential as well as the agriculture, and I can tell you they're two very, very different beasts altogether.
Hmm.
When you're looking at just a land purchase, now every lender is going to be a little bit different in their guidelines, and certainly, agriculture versus residential lots and that kind of thing. But since we're focusing on agriculture, those do come with higher down payments. So you will have to have more funds in order to qualify for those. So, your down payments, like for our products, anywhere from 25 to 35%. And then our
That's
minimum,
for just that's just for a piece of raw land, basically.
right,
No
right,
structures on it. Okay.
exactly.
Yeah, that's because what is the rationale behind that? Just so that we can wrap our heads around it. There's less of a potential for income from that property, therefore there's more of a risk for the lender. Is that correct?
Right, right. Like obviously the land isn't going to blow away like a house could, but the
Right,
land
right.
the land also doesn't have any kind of insurance requirements on it either. So when you make that purchase, that lender expects that there is going to be more skin in the game, as opposed to having a dwelling on the property that can be insured, and so that the bank knows that okay, if something happens, we can recoup the investment. And that's where, the higher down payment comes into play on those pieces of land.
Got it. Um,
Yeah.
if you're looking for the best loan terms, you'll need to have the home on the property.
Mm.
Otherwise, you are going to have to put a lot down.
Right, right.
um, so it makes it a lot harder to get into that property. Whereas just add a little 2-bedroom, 1-bath house to 100 acres, and now you can actually get a conventional loan for 3% down.
Right.
And it's yeah, and you still get all that acreage with it, and you have a place to stay when you're
Yeah.
there. Um, okay, great. So well, let's. So just so we talk about some of these. What are, in addition to just a conventional loan where you can put a small amount down? What are some other sort of opportunities for people that are out there in terms of the types of loans and just to familiarize people with these kinds of names and ideas?
Sure, sure. So we've discussed a little bit on conventional, briefly touched on USDA and VA being zero down payment options. Um, the other government-backed program is FHA. Most people are familiar with hearing that term. That is a 3.5% down payment option. And a lot of times we'll utilize that option if maybe we've got some credit scores that they've got a few dings on it, or they've been beaten up pretty substantially. FHA is a whole lot kinder when it comes to slightly imperfect credit. So that's another thing that people try and qualify themselves without talking to somebody. They hear that, oh, I have to have a perfect credit score. Well, I don't have a perfect credit score. What do I do? So you don't need a perfect credit score. It helps. That much is true, but it can be dinged up a little bit, and you could still potentially qualify. So that's where FHA comes into play.
Got
Um,
it.
and then some other options that some lending institutions may offer, and certainly some institutions may have their own portfolio products that they can keep in house. So those terms will be different than anything else that's offered, or anything that I'm discussing. But um, you know, down payment assistance programs, where they supply some or all of that down payment. Um,
Are
now,
those supplied in?
Hmm.
in the form of how are they supplied? Is that a loan? Is that a grant? Or how does that work? I mean, it
Yes.
seems like it wouldn't make that much. Yes, yes is the answer.
Yes is the answer.
Depends. So there are multiple options. There
Right.
are there are it now if it comes as a loan. I think you mentioned there were forgivable loans even in some
Hmm.
cases. So it might be a loan, but essentially it goes away if you meet
Correct.
all the continue to make payments and things like that and whatever do
Right.
all the right stuff.
Um,
And
yeah.
so that's I mean, and this is area by area. Is that correct or
Correct, correct. So
okay?
each state, and maybe even each county might have a version of that, but typically the state will have their main funded source. So, you know, our area, like around Kansas and Missouri, I'll use that as an example. It's been some years it's a grant and some years it's been just like a silent second mortgage so that you don't make any payments on, that may be forgivable after a 5-year period or a 10-year period, depending on how long you live in the property. And then if you say it's got a 5-year for forgiveness, and you move out in year 3 or you refinance in year 3, then it's going to be prorated. So whatever that state has given you, you'll have to repay 2 years worth since you touched or you did something with that mortgage after that third year. So that's what those forgivable seconds are. But like you had mentioned, each state is going to be different, and certainly, like in our area, the program isn't the same every single year. And why they do that, why they change that, I don't know, but it's
Right.
each year comes with a different set of stipulations or guidelines.
Got it. I mean, I just think it's really helpful to know that that exists, and so
Yeah,
that
yeah,
we can't give specifics here for everybody, but so that we bring awareness and people can start doing the research in their local thing. I think is really, I mean, these are just again some mind blowing things for especially a first time person who, first of all, didn't realize they only had to put 3% down, and second of all, didn't realize that there might be somebody out there who would give them that 3%.
right, exactly.
Um, so that's really freeing and very cool to find out for, I think, a first time buyer who's, just been stressing about they're going to have to save for 20 years to be able to,
Hmm.
even put down something to buy a house, to buy a cheap house.
Right, right.
Um, so, and then I just want to touch back on a couple different things. I know from FHA, because that was the first, that was how I bought our house that I live in now,
Hmm.
and so it came with I think it's 3.5% down for FHA,
Right.
or it was at the time. I don't know if they've changed those, but um, so because of that, there was mortgage insurance, the PMI. The
Hmm.
difference between a conventional loan, as I understand it, and FHA loan is the FHA has a 5-year minimum requirement for paying that PMI. That even if your house value or your property value increases significantly and you have more than 20% equity in your home, you can't get out of, like, it doesn't go away. But as I understand it, in a conventional loan, you could actually apply to just have the mortgage insurance dropped if your property appreciated and you found yourself with more than 20% equity
Right.
after a couple years.
Right. So,
It,
and I'll just pop in here for a real quick second. So,
please, yeah, what's up?
with conventional, that is true. That if you put a minimal down and you say, okay, well, I'm going to put 5% down. Um, Typically, how it works, it's one of two options can happen with that PMI. So the first is just leaving the loan alone. You don't touch it, and then once you reach a 78% loan to value ratio that's based off of the initial assessment, then that PMI will automatically drop away. But if, as you say, you believe the home appreciates enough, you can always go back and petition that lender or whoever is currently servicing your loan. Petition them to have them remove the PMI out of the payment earlier than when it would just automatically just drop off on its own. So they'll send someone out to assess the property, and if it has appreciated enough, and at that point it's not 78%, it just needs to be 80% loan to value, and they'll drop it. So,
Got it.
excuse me. Then with FHA, um, FHA is a lot different. So
Okay.
they've changed some of their guidance and views on PMI as well. So the new regulations for PMI on FHA loans is that PMI stays on the loan for the life of the loan,
Wow.
regardless of what loan to value ratio or how much equity you have in the property. So the only way to get rid of that PMI if you're in an FHA loan is to refinance it into some type of conventional product.
Right. So just you have to refinance out of your mortgage into a
Right.
new one,
Right.
basically. Okay. I think that's a good overview. I mean, we could certainly go into depth, but I think that gives people some heads up about some
Yeah.
things to consider.
Broad strokes.
Yeah. Yeah. And so let's just again go real granular and take all this down to the level of I'm a first time home buyer and I come to talk to you. What can I expect? Like what's the process and how can I what should I be thinking about in my financial situation that I could do to make it an easier process or to set myself up for being able to afford the maximum amount that that my income and everything else could will provide for.
Sure.
With yeah.
So I always tell people that pretty much what you're going to be looking at or considering is just a 2-year snapshot. So they're going to want to look at where you've worked for the last 2 years, where you've lived for the last 2 years, your income, what your assets look like, and certainly what your credit looks like. So just keep that 2-year snapshot in mind. So they don't like to see a whole lot of job hopping. So if you're a guilty party to having 13 different jobs in a year, you might want to pump the brakes on that a little bit.
Right.
um,
Or have one job that you
yeah,
have
one
kept
steady.
consistently. Yeah,
Right.
like one steady, like it might be part-time, but at least you've kept it for
Right.
2 years or
Right.
whatever.
So they're looking for that history, the consistency, uh, and that kind of thing. And then when we're looking at credit, of course, ideally we don't want to see any late payments. If there's a history of that, that could be problematic for underwriting. They'll want explanations, what happened here. So it's going to dig pretty deep into some of those things. So
Yeah.
um,
And as
keep.
as I discovered recently, not just I mean, having good credit is great, but
Yeah.
if you carry a large balance from month to month, for example, so I was like putting business expenses for one of my jobs, that it's not my business, but I was doing expenses on my credit card, and I would pay that off every couple weeks, but the average per month was like a couple $1,000 balance, and that has to be added to my debt to income
Right.
ratio, which affected how much I could afford because they saw that as like, well, you have a couple $1,000 of debt every that we have to account for, and I'm like, no, I don't. What are you
Right.
talking about?
Yeah, it's paid every
Um,
month. Yeah.
yeah, I get paid, more than once a month. So, but that's just, one of those things I learned recently. So even if you have good credit, that is something to keep in mind as well, like keeping low balances on your credit,
Exactly.
as much as
Exactly.
possible.
Um, and that's the other thing when a lender goes in, if you can pay those balances down, maybe even a month before, any kind of credit pull or anything like that, just so that those balances can all report up to date. It can take some time for those payments to really trigger on credit. because when a lender goes in and they pull that credit, it's just going to be a snapshot. And we see a lot of times, particularly with self-employed people, there's a lot of credit utilization going on. You max the
Yeah.
cards out and then you pay them off. You max the cards out and pay them off. But if you pull that credit the wrong time, it's pulling that snapshot, and now that's what they're going to use for
Right.
for
Right.
underwriting. So that just kind of be cautious of.
That's good to hear. And now I have a question. I've heard, so if you're, let's say you're getting funds as a gift from
Uh-huh.
somewhere, or I don't know, you're moving money somehow, like you're taking it out of this and putting it into your checking account so that you can use it as a down payment, or for whatever it is. Is there a time to do that? Like, do you want that done before that snapshot as well? I mean, is that as
Um,
important? I've heard different things about this. Like, you want to see the money in there. I don't know.
Yeah, I mean
Or
it can be, and it might not be, but
okay,
if it is legitimate gift funds from a family member or relative, then we just have that individual fill out a gift letter, and this is where there is some pushback. Sometimes they'll require a copy of that donor's bank account, and the big question that comes into play is, why do they need to supply that? They're not on the loan. Well, no, they're not on the loan, but now they are technically a part of the process, and underwriting always has to draw the points from A to B to C. So they have to see where those funds originated, that they were already in the account, that they don't have to trace anything further back. So um,
got
that
it.
that can get kind of hairy with some of that paperwork and explaining that to people. But ideally, if they're going to be transferring funds around, we like to keep the accounts as static as possible. So trying to finish any kind of transfers or moving assets or deposits or anything like that, uh, with probably a 2-month time frame before we start collecting financials. That way, we consider those funds as seasoned funds, is what underwriting calls it. So
Uh,
those transfers or deposits won't show on the bank statements that we collect. So imagine if you have transferred a bunch of funds around in February. Well, if we start collecting bank statements in April, those obviously are not going to be on the bank statements. So there's not going to be anything extra to explain.
got it. So if you're, planning to use those illicit funds from, your arms dealing days and you want to move them in from an offshore account, do it well ahead of this
Do it
process.
earlier rather than later, because we don't want to know.
Okay. So, but okay, so we're in the midst of this process, and I don't want to lose sight of what you're telling us, which is, somebody's come to you, they're getting approved, and that the goal of this process of talking to you at the beginning of this, I want to buy a piece of property. The goal in talking to you is to get a pre-approval. Like, that's the first step, at least.
Right, right.
So before we ever go to underwriting or anything like that, I come in, I say, hey, I really, think I'm ready to buy my first property. Here are all my things. Here's my last 2 years of, pay stubs and
Yeah.
W-2s and taxes and my employment information, run my credit. And you're like, great. And then what do you come back to me with? What do you say at that point? Like, what's we're prepared and we've done it, all that. What
Yeah.
my goal is this pre-approval. And I mean, yeah,
Okay.
please go ahead. Take
Okay,
her
so
away.
so a couple different things. If we're talking, land and that kind of thing, all that goes through underwriting up front, along with
Oh, okay.
financial financial documents, and so it goes through a physical underwriter, because those are all treated as what we call manual underwrites. So there's no way for me to go in and approve somebody just by looking at their financials. I take all that information, make it pretty, and then send it to the underwriter, and they come back and say, "Hey, we're good." They may give kind of a maximum that they can qualify for, or they may change the terms and come back and say, well, if they want this purchase price, then we're going to have to utilize this program, or maybe a slightly larger down payment. If we're talking about residential, we don't typically require any kind of financial documents up front. The one caveat to that is, of course, self-employed borrowers will require their tax returns, just so we can crunch the numbers on our end, because what they see as their bottom line is what they're paying taxes on. So that's not ever what we're going to use as the qualifying figure for their income. So there are
Right.
things that we can add back in. Now, if going back to it being a residential property, those aren't usually manual underwrites. So I run everything myself. And I'll come back to them, and we may have an initial conversation and say, okay, well, what kind of payment range are you wanting to be? If it's somebody, they may have some very unrealistic
Oh,
expectations. So I'll kind of go in backward, as opposed to looking at purchase price and then qualifying from there. Qualify them off of the payment that they want. So if someone says, hey, I don't want my payment to be above 1,000 a month, well, then you probably need to stop looking at $600,000 properties, because that's
right.
not realistic. So,
Right.
we kind of go in backward uh, in that case and say, okay, you
Got
want
it.
$1,000 payment. This is your purchase price range that you're going to want to stay in.
Got it. Okay. That's much more interactive than what my experience has been, generally speaking. I
Yeah.
mean, obviously I'm in LA, and it's, maybe we have maybe we have some highly taxed, overtaxed mortgage brokers here who shorthand everything. Um, but m- yeah, that definitely sounds much more interactive. I would have loved a conversation like that, of just asking me what I thought was realistic,
Hmm.
because what my experience was, I submitted all my stuff, and what the mortgage person came back to me with was, here's your number. This is the max that you can afford.
Yeah.
And whatever that is, it's like based on your income, your debt, your debt to income ratio, all the factors that they take in. Here's the number. Here's the magic number, and anything up to that you can afford.
Right. Right.
And as low as that was, because I was never a wealthy high earner, um, I still was like, wow, if I actually bought a home for that, I think I would probably have to live off of rice and beans and never
Yeah.
go to a movie, kind of thing. Like, I mean, it was like, here is the max that you, yeah, literally can afford, if you, and still just survive without starving to death,
Right,
basically.
right. And that's
Um,
that's what I can certainly do that for someone, and I do get that question, what's the maximum I can qualify for? And it may be something that is well outside what they're really wanting to pay. So if I come
right.
back to somebody and I say, "Hey, you qualify for a $5,000 a month mortgage payment," and they go, I I
Yeah.
don't want to pay anything over 2,000. Well, then we get into that situation where we're trying to qualify people and max them out, so that essentially they're going to be house poor. I make
Right.
my mortgage payment, and that's all I can do that month. No movies,
Right.
no eating out, no nothing. And so
Right.
that might not be what everybody wants.
Right. And maybe that's fine if you really like know what you're doing, and you're buying at the right time, and you
Yeah.
you know that home is going to appreciate, or you're going to live in it, and really fix it up, and know that you're going to get some sweat equity into it, and there's a plan to get out of that situation. But a lot, I mean, that's a far cry from where most first time property buyers are.
Hmm.
And and so it's, you exercise caution. In other words, when you get that number, if you work with the kind of mortgage people that I worked with, be careful when you get that number and think soberly about, do you actually want to buy a property for that amount?
Right.
You know, I mean, and I was fortunate in that I was qualified for myself, and then shortly thereafter married my wife, and so then we had a whole other income set to add to what I was approved for, so it made sense.
Mhm.
So that's another thing to think about. Like if you're, if there's if you know that somebody's going to be sharing that mortgage with you, and yet you're getting it approved a loan, maybe you can afford that maximum.
Right. Right.
Um, well, great. I mean, I think this is like all. I think we've covered some really good stuff, and I mean, there's so many things we could touch on. It's really real estate goes, as deep as you want to go. There's so many. I mean, I was just listening to a podcast today where they were talking about wraparound mortgages and subject to
Oh gosh, yeah. Yep.
situations, which is high level investing where you definitely need to involve attorneys and cutting those deals and structuring those deals and writing up the paperwork for them so that you are actually being legal in what you're doing and also not getting screwed.
Right.
But I think that's the point. I wanted to tantalize people with the opportunities that are available just for your first time, but also, what that can lead to, what owning real estate could, move to. I mean, for better or for worse, I'm not, obviously not creating any judgment about this, about the ownership of property in a place where, I mean, a few hundred years ago, that idea was foreign. The idea that land could be owned, and now
Yeah.
it is, the for better or for worse, the basis of our economy, and something that I think is a form of financial literacy that is sorely lacking and desperately needed,
Hmm.
for many people, to be able to navigate this world, the world of
Yeah.
America, the economy of America, and beyond that. Honestly, can you talk, just any final thoughts about, let's say you're maybe a little more advanced than a first time buyer, and some of the situations that you've seen, or things that you can speak to in terms of agricultural loans, and I think what you talk about is, on the website. The way I found you was the idea of a hobby farm. So
Yes.
somebody who, may live in San Francisco or LA or New York or some urban center, and they are thinking about, at some point I want to have a different lifestyle.
Right. Right.
And so can you talk a little bit about that, like what's entailed, and what you've seen, like what people will need to expect when they're thinking about buying a vineyard in the country, or buying land in the country that they could use to make wine
Right.
in
Right.
some way, whether it's vines or trees or whatever.
Sure. So a couple of different things, and I'll speak to just kind of the bare land or vineyards, orchards, that kind of thing. Those properties, when we go in, and say they are zoned agricultural, we like to see that the property. When you're looking at different properties, we want to see that either it's currently being used in some type of agricultural capacity, or that it has the potential to produce some kind of agriculture commodity or product. So that is a
Mm,
very, very broad definition with agriculture. Some people may not realize that uh, that also includes, maybe fresh cut flowers.
mm,
You know, bee farms.
right.
The vineyards, of course, the row crop. All of these things can be used as an agriculture commodity. So that's what we look at when we're trying to qualify a property. So just something to kind of keep in mind when if you're out, this first time that you're buying land, that's kind of what our products are geared. But the other side of that coin is that hobby farm loan product. That is a unique product because most properties, when you look at, and you can certainly buy a house on acreage with conventional financing, but a lot of times you'll find that lenders will limit the amount of acreage that you can have, uh, because Fannie Mae and Freddie Mac guidelines, they want to see that, that house, um, out of the total value, they want to see that that dwelling has the majority of the value attributed to that property. So they like to see, 65%, 70% goes to the house, and the rest, the smaller percentage, going to the land. That's much more difficult to do on more sizable properties. So you get into that 100-acre, 200-acre uh, type of property, and all of a sudden you find that you can't qualify for conventional financing, which is where that hobby farm loan comes into play. So it's kind of that
Hmm.
happy marriage between residential financing as well as just a little touch of the commercial side of things. So
Oh.
it's for those properties that have the dwelling on the property already. It's going to be utilized for a primary residence or a secondary home, but it also allows for the larger acreage. If the property is already income producing or has those agriculture features on the property, you'll find that most of those conventional loans, they won't qualify, and so people get frustrated. They've found their dream home. It's an equestrian property, or it's got 40 acres of a vineyard on there, and all of a sudden they can't find a mortgage, and so they can't get the property. Well, that's where that hobby farm loan comes into play.
Oh. So I'm guessing that the analysis is a little bit different because it takes in both just the value of the asset as well as the potential income producing aspect of the
Right,
land
right.
itself. Got it. Okay. That's very interesting. And then are the terms different for that? Like is the down, what somebody needs to
Um,
put down and
Yeah, a little bit. So the main basis for that product is a full 20% down payment, but certain states, we can sometimes add a second mortgage to the back end that will absorb up to another 10%. So
hmm.
I could say that that could be anywhere from 10 to 20% as a down payment.
Got it. I see. So it'd almost be like a two loans if it was 10% down kind
Right,
of thing.
right.
Got it. That's fascinating. But it sounds like it's geared for somebody who, likely is making enough, probably live somewhere else, and this is a
Yeah,
second home kind of
yeah,
thing. Got it. Uh, no, that's. I just wanted to talk about it since it was, it's something that you guys seem to specialize in, and it
yeah,
is an
absolutely.
interesting opportunity. Well, and speaking of that, are there any other resources just that you suggest people, look to if they are embarking on this process?
Oh gosh. Real estate agent.
Right. So number one, mortgage. Number two, real.
Yeah.
Well, and that's the thing. I forgot to close that loop, which is like, right. Real estate agents do come in very handy. After after a potential property purchaser, we'll say instead of a
Yep.
home buyer, speaks to you and gets that financial snapshot and gets the approval for whatever that is, whatever that amount is, then they can go to an agent. Then an agent is much more happy to talk to you when you say, look, I already have my pre-approval of X amount of whatever, and I'm looking to buy X kind of property. Can you
Right.
help me do that?
Yeah,
And then
they're
the agent's like, absolutely, like let's do this.
yeah, they're
Because
much more
you just made it
receptive.
right. And that's where they really come into play and can help facilitate because they're now going to have the conversations with the selling agents or sellers that you are, they're not going to be wanting to talk to a buyer. They're going to want to talk to an agent at that
Right.
point. And so that's why you need them to have those conversations and bring you the details and ideally represent your interests.
Exactly. Yep.
Although it does, I will say, from as a former agent, there are many things to look out for. Dual agency is one of them. That means that an agent can represent both the buyer and the seller. You want to avoid that if you can.
Mhm.
um,
Yep.
because at the end of the day, well, I hate that phrase, at the end of the day, but an agent at the end of the day the sun sets. um, an agent the joke was made in some movie where it's like they make money whatever happens, basically. So you
Right.
could argue that they have a vested interest in the transaction happening regardless of how it happens, because that's how they make money. But you know there are many good agents out there, and I don't want to be cynical about anybody, and but it is set up that way, so you do have to look out for your own interests and question, because I've seen that there are bad agents out there as well who are will lie to their clients, etc. I've encountered it all, if you
Right.
stay in the
Right.
business long enough. So just a cautionary tale. If you have somebody you know and trust that's also an agent, that's great. And otherwise, and even if you do, always do your own homework and think carefully about the things that you're being told. Get as much information as you can on your own.
Right.
Trust but verify, basically.
Yeah, exactly. There you go.
But let's I want you to have a chance to talk about your company and whatnot. Is there who do you work for, and is this somebody you would recommend people contacting you? Would you recommend people getting in touch and reaching out to you?
Yeah,
And
absolutely, absolutely. So our main company is called United Mortgage. The agriculture division is United Ag Lending. So it's the same company. It's just the agriculture division obviously has specific designated individuals who do work on those loans, since they are so much different than just your more traditional financing. So, again, I work on both sides. I still do all of my residential things as well as the agriculture side. So, and we do loans pretty much all over. We're specifically licensed well, I guess I should say we're getting additional licensing, but that's also in the works. That's so that we can do the more of the residential side as well.
Got
So yeah, definitely. I'm happy to answer any questions or kind of help um, walk through some scenarios, anything like that.
and what is your company's website, and any contact information that you'd like to give?
I mean, they can go to it's pretty simple. Just unitedmortgage.com or unitedAgLending.com are the main
Got it.
websites.
And is that the best way to find a contact page and start asking those questions? Or is there a direct contact that you want to give out? You certainly don't have
Oh,
to, but
yeah, yeah. My direct line would be 913 378 2816. And then I've got two different emails, but uh, it's either B Shepherd at umloans.com. That's BShepHer. Or the other email on my agriculture side. I know it gets a little confusing having two emails but for the same company, but would be B Shepherd at unitedaglending.com.
got it. Well, thank you so much. Do you have any closing things? Is there anything that we missed, or that we covered, that we should give any caveats to, that you want, any close, or just any closing thoughts?
I know that the market right now has been a little scary to deal with, but as long as you've got the right individuals working with you, those kind of things can easily be navigated. But you have to have the right team set up and in place, and make sure that they've got your financial interests in mind. And I think that's about it. So uh, I try and tell my people that the buying process, whether it's buying land or buying a residence, that process should always feel seamless to you. So let me deal with the stress and run around with my hair on fire. I would much rather prefer shouldering all of that than having the buyers deal with that.
Yeah, that's great. And I know that so much of this process is that, especially if you haven't been through it, is that fear of the unknown, and
Absolutely.
it's such a big deal. It's one of the as a a cliche, but it's one of the biggest purchases you'll make in your life usually. And so understandably, people get very caught up in emotion about it.
Right.
And so it is great to talk to people who know a lot and just are willing to answer all of your paranoid questions repeatedly.
Right.
I can't say enough about how important it is to just talk to smart people who know more than you do and can sort of guide you through the process. It definitely helps. And I have nothing to sell in this. I'm just other than I think, like I said, my whole mission, for a while was really to help spread the word about how important this kind of knowledge is to just being, financially literate in our economy, and in hopes that it will reach somebody who, it turns on a light bulb and, may change their life in the sense that they start a process that pulls them and their family into a different financial situation than what maybe they grew up with or whatever.
Yeah.
So thank you so much for your time and
Absolutely.
all this invaluable information that you provided, Brady. I really appreciate it.
Absolutely. Thank you so much.